In this video, we'll look at a couple of different arbitrage trades that we can carry out in crypto. An arbitrage being that we can take advantage of price differentials of the same asset across different markets. And so hopefully we know when we enter the trade that we can earn some sort of arbitrage yield out of that trade without taking directional price exposure to the asset. So we're not just buying and selling and hoping the price goes up or down. In fact, if the price goes up or down, it shouldn't worry us too much because we're just taking the yield out of the arbitrage trade. So I'll show you here how to trade. You can take both sides of the trade on OKX. They make it really, really simple. They've got a arbitrage trading system. On Binance, they have this as well, which actually makes things super easy. So it's very easy to carry out. Now, I'll leave some links below to Binance, OKX, the other exchanges I use down below if you want to get deposit and trading bonuses if you're new on those. And some other helpful videos on all of these strategies. I'll leave those videos down in the description as well. The first type of trade we'll look at is known as a spread arbitrage or calendar spread arbitrage or spot futures arbitrage. So OKX actually give us a trading system where we can carry out both legs of the trade simultaneously, which is great. I haven't seen this on other platforms, so I'll show you on OKX. Go to trade if you have an account, trading bots, marketplace, and then here it's arbitrage. Click that, it takes you through to this screen. We can trade both legs of the trade simultaneously. Up in the top left, we need to choose spread arbitrage and then futures spot. That's what FS means. What exactly are we doing here? We're carrying out an arbitrage where we buy an asset right now, and we have that in our account. So that's a spot long that we have there, right? So we're long the asset. However, at exactly the same time, we sell the futures contract at some expiry in the future. And that futures contract, essentially we're going short that futures contract. But there's a difference between the price we buy today and that futures contract is priced at a different price because in the future, the market is going to try and predict or discount what the price would be in December this year as of making this video, which is about 6 months away. So we can buy Bitcoin now, and the market right now is telling us that the December contract is trading at a price above what the spot price is trading now. That's the spread between them. So what we can do is go long in the spot market, immediately sell that exact same amount in the futures market, and that spread is our arbitrage. You can see the spread rate here is 3.73% between the two prices. So that's our arbitrage. And the APR, because this is 6 months, but if you did that for 12 months, the APR would be around 7%, 6.88%. So we can go ahead and go long in the spot market. So we have long price exposure, but we immediately sell the exact same amount in the futures market. And so really by the time the contract expires, these two prices should merge to be basically the same. And so that spread should actually narrow, and then we basically make that spread rate, which is 3.73% over 6 months. The reason this is known as an arbitrage trade is because we should be locking in our exposure when we actually take the trade, and the price differential between them is what we make. So let's say I go long 1 Bitcoin, and I also go short in the futures 1 Bitcoin. I now have a liability that when this futures contract actually expires, I have to deliver 1 Bitcoin, and I'll be getting 101,000 for it. Well, I already bought the Bitcoin at 100,000. And so price movements within the time frame don't actually matter, right? Because you've already bought the Bitcoin for 100 and you've already sold it for 101. So if this goes down, let's say this moves down in price during the time frame to 99,000, right? Then yeah, you are making a loss on that side of the trade. If you sold it just in the spot market, you'd make $1,000 loss. However, with that $1,000 loss, that Bitcoin is now worth 99K and you just deliver it for 101. So what you've done is, yeah, you've lost 1K in the spot trade, but you now make that up by making 2,000, delivering it for 101K. And so again, the spread between them, which is 1,000, is still there, right? And it doesn't matter. If this moves up, right, what you're doing is, let's say this moves up to 101. So now you've made 101,000 on the spot side, right? So you made 1,000, but that doesn't matter. You've already sold at 1K, right? So that 1,000 that you made doesn't make any more. You get cancelled out because you're selling at 101. So again, you just make this difference, which is 1K, right? So what you're doing is locking in this price difference then and there, and then you just have to wait for the contracts to expire, and then you just deliver the 1 BTC because you're not on the hook for a dollar amount. You're on the hook for a Bitcoin amount. So if you're buying Bitcoin right now at 100 and you're selling it immediately at 101, that is your profit. And you make that. And all you have to do is just wait till the contract expires to deliver the 1 BTC, and then your profit actually comes to you out of that trade. There are still some considerations to trades like this. The first one is the amount that you're making. So over 6 months, we're making 3.73%. The APR, if we did that over a year period, would be 6.88%. That's pretty good for cash, but just buying Bitcoin for a year may yield much higher amounts, right? 10, 20, 30, 50% even. Although you get price volatility in the Bitcoin, whereas that's not what we're looking for here. So it's up to the individual and the mix in your portfolio, what you want. Maybe you're looking for some more reliable cash to be brought in, and so you're giving up some of that potential upside for more reliable cash that you're making out this trade. The other side is just managing the short trade. Because we're buying in the spot market, so we're buying with cash there, so there's no leverage on that. But OKX default to 3x leverage on the short side in the futures market. Now that should be fine because we have the same liability, right? We have a liability to deliver 1 BTC on the short side and 1 BTC in the spot account that we have. So we should be fine there. However, if you get extremely violent price moves, it may be that you actually get stopped out on this side. The reason being is that you're using 3x leverage. So if you're short, the price can move up and you're 3x leverage. So if you have $100,000 short position, you've only got $33.33 thousand there to fund that short position. So potentially if the price moves up violently by that amount, then you could get stopped out on that side of the trade because you've only got a certain amount of cash to fund that side of the trade. Now on the other side of the trade, your spot BTC should be moving up as well to cancel that out, but you're not leveraged on this side. So there should be maybe a small discrepancy here where in a very volatile event, maybe the short side potentially gets stopped out because you don't have the assets there to pay for the potential liability, right? And so you have to make sure that you're comfortable taking a certain amount of leverage, maybe 1x or 2x that you can take in a crazy scenario where the futures price blows out up to the upside and the spot price doesn't, actually gain equity in your account moving up as well. You may get stopped out. So that is a potential risk. Using 1x leverage is fine as well, which is no leverage at all, right? So you're funding the position in its entirety. The only downside there is that you have more cash tied up in the short side of the trade, which means you can't put as much in the long side, right? So the balance here is to use an amount of leverage where you think it's fine and you can handle volatility, but you want as much cash as possible in the long side so you can have more cash in this trade, right? The other thing is if you're using OKX or any other platform, go to the settings here. You have to make sure that your account mode is in the right account mode. You want either futures or advanced where you're using cross margin, because what you want to be doing is using the equity value, the dollar value of this to fund other positions that you're trading in this futures market. That means that this side of the trade can cancel out this side a little bit, because if they both move up, this one loses, the short loses, but then the long side obviously moves up as well. So you want to be using this as collateral to fund this trade. If you don't, then what you've got basically is this side of the trade that you have to fund with cash only, and it's not capitally efficient, right? So you need to make sure that you're in that position in your account right here where it says account mode. The other thing is we just have to make sure we're trading the same amount. Amount on the short is 1 BTC, that's our liability. The amount here long is exactly the same. It has to be exactly the same. What you want to do is also try and trade the exact price that you're seeing here. So you can click this button where it says one leg will be taken under market price once another leg is traded, and that's what you want. So on the buy side, you can just very easily put a price in here that you want to trade, right? So this is the long side. This right here is BTC USDT. So current price is 109,670, something like that. And once you press both legs, if that trades, then it will take the corresponding short side in a market order, which will be around this price, 113,742, and you will lock in that spread amount. So that's it. You can just choose the amount of BTC that you want to go long, and also have the short here. Make sure that they are exactly the same, right? So you don't want any discrepancies. 1 BTC, same amount both sides. Do this side of the trade if you want. The other side will be taken if you have this tick box on. And then your long 1 BTC, that will be in your account here. The value of that, if you are using the cross margin feature, will be used to fund this side of the trade as well. And the equity from this, if it moves up, will start paying for any losses here. If you're making wins or gains in the short side of the trade as the price moves down, then you'll just be in profit here, so you don't have to worry about it. And obviously the short side will be losing a little bit. But the whole point is they net each other out. You wait until the contracts expire, and this price differential, 109, 113, that actually comes to us as the arbitrage, which currently is 3.73%. The next type of trade that we'll look at is known as funding arbitrage. And in this trade, we're again trying to take very minimal or no price exposure whatsoever. And we're trying to cream the funding rate that we get out of the market off the top of the market. So whatever that funding rate is, that will be our yield. Now, in funding arbitrage, this yield can change over time. And so that's one of the risks or considerations for this trade. But hopefully what should be happening is that we have very minimal or no price exposure. So how does it work? What we're doing here is taking advantage of the perpetuals market in crypto. So in crypto, you have the spot market, of course, which is, let's say, Bitcoin USDT. That's where people buy and sell those two assets and they're cash settled. So that's the spot market. In futures, you can see the perpetuals market here, which is a type of futures contract with no expiry date. And so this is a synthetic market that people can trade. The reason being is if you're day trading or if you're hedging your portfolio, it's much more efficient to use futures or perpetual futures because you can put less cash down in the trade and you can take positions that benefit from the price going up or down. So you can go long or short. And so a lot of people trade this, but the issue here is that this is a different market to the spot market, but the price of this market should stay exactly the same as the spot market, right? Because otherwise the perpetuals contract is unreliable if it doesn't track the two currencies that it's supposed to track. This is a different market though. And so the price has influence from buyers and sellers completely differently to the spot market. So crypto exchanges have to make sure that this price stays one for one with the spot price of the currency pair that you're trading. The way that they do that is through a funding rate. This is basically a fee or a incentive or disincentive, whichever way you look at it, to make sure that this price keeps in line with the underlying spot price. So as an example, this is the spot price here. And if the futures market has too many buyers that are pushing the price up higher than the spot price, those buyers that are going long and pushing the price up too high are going to have to pay a fee for the other side of the order book. These guys are sellers, right, that are coming in that are trying to sell and push the price down. But because the futures price is too high, this is known as positive funding, where buyers are paying this fee to short sellers. And so that short sellers get the fee. Now, the other side can work as well. If there are too many sellers that are pushing the price down, this is known as negative funding. The price is lower than the spot price. That's not good. The exchange needs to bring up the price of the futures contract. And so these guys will actually be paying money to buyers who are trying to push the price up. And so that's known as negative funding. So in crypto, most of the time, in the strong assets anyway, funding is positive, meaning that there are buyers coming in, pushing the price up a little bit higher than the spot price. And so those buyers will be paying a funding fee to sellers or the short side of the trade. Now, what we can do is take what's known as a positive carry trade, which is we basically take a short trade here that's cancelled out with a long trade, and we receive that funding rate from the buyers in the market. So hopefully we should be delta neutral, which means the price moving either direction doesn't matter to us, but hopefully the rate environment is positive, and that means we're getting that funding fee from the market. How it should work is that we take a delta neutral trade, meaning that we take a long and a short of the same amount, so price movements either way cancel each other out. So let's say we go ahead and take a one ETH long position in the spot market. So we're now long 1 ETH. That's not delta neutral, we have price exposure. So what we need to do is go short in the futures market 1 ETH as well. And so we are long 1 and short 1. So that's delta neutral, meaning that, you know, whatever the way the price moves, each side of the trade will, with the profit and the loss, will cancel each other out. But the short position should hopefully be in a positive funding rate environment, earning the funding rate. And that, whatever that may be, if it's 2% or 10%, that is the yield and the arbitrage that we're taking out of the funding rate trade. Both OKX and Binance have pretty easy to use funding rate arbitrage trading systems. So what I've done here is gone into bots. So I think this is in the spot market or the trading screen. If you go to trade, spot or futures, on the right hand side, go to bots here. So tools like this, and then we should see trading bots. And then you want to look for smart arbitrage. It's actually, I think it's new from OKX. And what they do is they give you a set of assets that you can very easily carry out this trade with. So you don't have to take the long position and then work out how much the short position should be. It basically just does it for you. It says, how much do you want to put into this trade? We will carry out this trade, the long side, the short side, and that's it. Now, with some crypto assets as well, not Bitcoin because it doesn't pay any staking rewards, but some other assets like ETH and Solana, they pay staking rewards as well. So actually what you're getting, hopefully, is the funding rate on the short side of the trade, but also the long side of the trade may be paying some staking rewards. Let's say that's 3%. And if you buy this side of the trade and you buy a staking derivative on the platform, you should be getting that as well. So you're getting the staking reward plus the funding rate as your yield out of the trade, but no price exposure. And this is going to depend on the staking reward, which can change, and the funding rate, which can change. And so the funding rate that you get, or the yield that you get out of this trade, isn't fixed. It can change over time. That's one of the risks. But anyway, we'll look at Solana, for example. You can see that the next APY is 17%. That's a yearly figure, but the funding rate down here is 0.01. The funding fee is exchanged every few hours on platforms. So once you put the money into this trade, wait for a few hours, and you should be starting to earn the funding fee from that. So let's look at Solana then, because it's 17%. On the right-hand side here, it just tells you exactly what's happening. You are buying in the spot market, and you're selling in the futures market. You can see over the last 90 days, the total APY, the arbitrage APY here, staking APY. So out of this on Solana, you're actually getting way more from the staking rewards than you are from the funding rate arbitrage. And you can see over the last, let's say 30 days, this is the yield that you're getting out, right? So the price of Solana doesn't matter. You're just creaming this funding rate arbitrage off. Every time the funding rate refreshes and you get paid, you can see you earn that money. Now you can also see there's some points where the actual yield that you get out of the trade goes down, and that's part of the risks of this trade. Like I said, in the funding market, funding is mostly positive because we are short, right? We're short one side. Now, most of the time when funding is positive, that's good for us, because if funding is positive, the short side gets the funding fee. However, on some occasions, if the price falls, the futures price falls below the spot price, the short side, which we are, may have to pay that funding fee. And so that's one of the risks of this trade, is that if you go into a funding rate arbitrage trade and the funding fee is negative and you're short, you'll just be paying out all the time. So you have to make sure that the asset you're going into, the funding fee and the staking reward are going to pay you that arbitrage over time. You may get some periods where you're actually paying out some money, but for the most part, like I said, especially for big assets, funding is mostly positive, but just something to be aware of. So you can see that over time. Let's do a different asset. Let's do ETH here. We'll just see what that is as well. So ETH, and we can see, again, we are buying in the spot market. We're selling the exact same amount in the futures market, in the perpetuals market. Over the last 90 days, you can see what you're getting here. So this is an annualized return, right? But you can see how much you'd actually be making. And then down here, what you do is just create the bot. Now, what we're doing here is putting an amount in, whatever that may be. We can see the countdown here. The spread rate is this. That's the difference between the spot and the futures, which is a cost when opening the trade. So you'll be in a slight loss in the trade initially when you get in, and then you have to wait for the funding fee to obviously pay that back. And down here, what exactly are we doing? Futures investment, spot investment, as you can see. And notice here it says be ETH staking. The reason being is that on the long side of the trade, we want to be in a ETH staking derivative because the staking derivative pays the staking reward. If you're in spot ETH in your account, there's no staking rewards for that, so you're losing out that money. So we obviously want that. And any proof of stake platform, ETH, Sol, and any others that pay staking rewards, if they have a staking derivative on OKX or the other platforms, you want to be in it earning that reward. But you can create that. It just does everything for you. And then you'll be in that trade earning whatever the funding fee may be. However, like I said, the risk here is that we are short in the futures, so we need that positive funding rate to be happening most of the time. If you're in a bear market, this can go negative, and then you'll be paying, and obviously you don't want that as well, so you need to get out of the trade. So you do need to make sure that you're looking at the trade every so often to make sure that the funding environment is positive for the most part. If you want to see me actually getting in and out of some arbitrage trades, I'll leave those videos down in the description, and these deposit bonuses to OKX, Binance, and the other exchanges I use will all be in the description as well. I'm James, it's Money DG. Cheers for watching, and I'll see you in the next one.